I am sure after seeing the previous few lessons, there may be several questions and doubts which may come to your mind. Let us try and answer some of them. The first question which may come to your mind is that what was the need to do all this? Why have we gone for hedging? Now, if you have gone through the lessons patiently, then this question should not come to your mind. But in case it has come, then the answer is that I wanted to protect the value of my portfolio from the falling prices, and therefore we had gone for hedging. You see, through the learning and analysis, we could foresee that the value of the portfolio is likely to come down. The price of the underlying asset is likely to come down, and therefore to protect the value of the portfolio, we had to do the hedging. All right. Then the question is, if that was my aim, was I able to do that successfully, and to what extent? And the answer to that is yes, I was able, or rather we were able to do that, and we did that to the extent of hedging. That means we protected the value of our portfolio to the extent of hedging. By that, what I mean is, from the time I took the hedge position till the time I exited that position, whatever was the erosion in the value of the portfolio because of the fall in prices, that much amount of money we could recover through the short position in hedging. And with that money that we generated, we could purchase more number of shares of the same company and top up our portfolio so that the value of our portfolio increases to what it was before we took the hedge position. I hope that is clear. And then you may ask me that what if the price had gone up instead of coming down? We could earn something out of the short position just because the price of that asset or the underlying asset and the derivative went down. But what if it had gone up? In that case, I would have lost money on the short position, isn't it? So the answer to that is yes. If the price had gone against what I had perceived, or if the price had increased instead of coming down, then I would have certainly lost money on the short position. But at the same time, the value of my portfolio would have increased because of the increase in the price of the underlying asset or the share price, isn't it? So therefore, on one hand I would have lost, on the other hand I would have gained. It would have been a no profit no gain situation, as is expected from a hedge. So the hedge would have been successful in that case also. And moreover, by the end of the day, if I felt that okay, the price has not gone down today, maybe it will go down tomorrow, then I can continue with that position till the expiry of the contract. And even if at the expiry of the contract I feel that no, I am certain about my analysis, the price will go down if it has not gone down so far, then I can roll over my position to the next series. And whenever I exit that position, I will be in a no loss, no profit situation. Got the point? But then you may ask me that in that case, by hedging, I have capped the upside potential of my portfolio. You agree with me that I have protected it from the downside. I will be in a no profit, no loss situation in any circumstances. But I am not gaining anything if the price increase. If the price increase, I am losing on the short position, gaining in the portfolio. So I am no profit, no loss in all circumstances. And the answer is yes, that is true. But the purpose of hedging, or my aim of hedging, was to protect my value of portfolio only from the downside. I cannot have both ways. I cannot say that I want to protect my value from the downside, but on the upside, I want to keep it open. If it goes up, I want the profit also. But if it goes down, I don't want to have a loss. No, that is not possible. You see, I cannot have the cake and eat it too, isn't it? Whatever we do has to be logical, all right? Then another question which may come to your mind is that not everybody holds shares in lot sizes. Most of us hold shares in small quantities and then build up our portfolio. Our portfolio may have several shares of different companies in small quantities but not in lot size. So in such case, can we do hedging? And the answer is yes, you can do hedging. But in that case, it will be through approximation. You see, the shares which you hold in your portfolio would certainly belong to one of the indices like the Nasdaq or the Nifty or any one of the index. So what you can do is you can short sell the index instead of short selling each share because you don't hold the lot size. Now in that case, you have to work out the beta of your portfolio. Beta is nothing but, like for example, if the indices move up or down by say 1%, how much would your portfolio move up and down? So what is the relationship between the movement of your portfolio and the index to which or the index to which the shares of your portfolio belong? For example, let us say that the total value of your portfolio is approximately 1 million. All right, you may be having about 10, 12 or 15 shares in your portfolio, and the value of all the shares together, let us say it is about 1 million. And let us say that the contract value of one lot of that index, whichever you are considering, Nasdaq or Nifty or Dow, whatever, let us say the contract value of that index is also 1 million. All right. And let us say that if that index moves up by 1%, your portfolio also moves up by approximately 1%. And if the index goes down by 1%, then your portfolio also goes down by 1%. Let us say if this is the situation. If this is the situation, that would mean that your portfolio is perfectly aligned to the index. And this is a good situation. In such situation, what you can do is you can hedge by short selling that index. You can short sell that Nifty or Nasdaq or Dow Jones, whatever. All right. So what will happen is, on one hand, if the price goes down, the value of your portfolio will go down. And on the other hand, because the index is going down, you will earn something on that side. And since your portfolio and the index are perfectly aligned, more or less whatever you gain by short selling the index, approximately the same amount you will lose in your portfolio and vice versa. All right. But it may not always happen that your portfolio is perfectly aligned to your index. Sometime or most of the time it may be different. Let us say, for example, that if the index, Nasdaq or Nifty, whatever, let us say the index moves up by 1% and your portfolio moves up by 1.5%. And similarly, when the index moves down by 1%, your portfolio moves down by 1.5%. That means your portfolio is more volatile than the index. In such circumstances, what you can do is you can short sell either one lot of the index or maybe two lot of index, because you cannot short sell 1.5 lot. It has to be in terms of lots only. So for example, if this ratio, if this percentage, say it is not 1.5, it is 1.4 or 1.3. So if it is less than 1.5, then you may like to short sell one lot of the index. And if it is more than 1.5% alignment, then you may like to sell two lots of the index. So I hope in principle you have understood the concept as to how you can hedge your portfolio if your portfolio does not have lot size of shares. All right, how to hedge with the help of indices. Now another question which may come to your mind, or rather most of the time people keep asking me, is that can we use hedging for generating income? Like all in the previous lessons, what we have seen is basically we have used hedging for the purpose of protecting the value of our portfolio from a downside. But can we use hedging for generating income? The answer is yes. But like any other method of generating income, hedging also would require knowledge, hard work in the form of some research, and also some risk taking ability. And how do we do that? We shall see in the next lesson, because this lesson has become a little bit long, and I'm sure you must not be in a receptive mood to continue with this lecture.